You have to accept that. Okay. And I'm going to turn our attention to the questions that were submitted, primarily from chapter two of the FAR book. I know that, you know, you can submit questions from any chapter one as well. And then there was one question that came from chapter one that I had missed last week. And so we'll go through that this week. But let's go ahead and start to take a look at these. Now, I don't see the person that submitted this question, so I'm going to go past this one to see if the person shows up. Um,
Professor, I'm here. That was me.
oh, I'm sorry, Friday. My bad. Okay, good. Thank you, sir. And this was a good question. Um, this is um, dealing with adjusting journal entries, and that's covered in chapter two. Now, adjusting journal entries are an important part not only of the CPA exam, the FAR exam, and so forth, but they are important from the standpoint of where your career is going. If you're in this class, the assumption is you're going to be taking the CPA exam, you're going to be getting your license, and you're going to be coming in some capacity as an auditor or maybe an internal auditor or some sort of capacity where you're using the license and or people are looking to you as a CPA to be able to help with these kind of things is that we have a problem with our financial statements. We recorded some things incorrectly. How do we fix it? I like to look at it as though you are the doctor of financial statements, and if your financial statements are sick, it is your job to cure them. Okay, so that was going on with this question, and let's just go ahead and sort of read through the information here. This Roro company paid $7,200 to renew their only insurance policy for 3 years on March 1st, year five. Now, just that right there. You read through that, and it would take some time to think about this. I think this question might take you about 3 minutes as you kind of let the fact pattern sink in. But here we're saying they paid $7,200 to renew their only insurance policy on March 1st, year five. Well, that means then that any old insurance policies would be expiring on that date. You don't renew an insurance policy before the old one expires. You renew an insurance policy when the old one expires, right? Hey, your insurance is about to expire. Even if you pay it before the the date that it actually expires, it would come into effect in this example on March 1st, year five. As the old one expires, the new one comes into effect. Okay. And they tell us that that was the effective date of the policy. Okay. Now they tell us that at March 31st of year five, the unadjusted trial balance showed a balance of 300 for prepaid insurance and 7,200 for insurance expense. Now, what I do, and guys, I'm not a huge fan of T account analysis for accounts. I'm not. But when it comes to the adjusting entries here, I think it sometimes does help to have a T account approach. So you're almost looking at the ledger accounts for these two things that they're going to ask us about, the prepaid insurance and the insurance expense. So you can sort of at a high level look to see, well, what's in there and what would be the appropriate ending balances here. And so for the prepaid insurance, well, let me put insurance expense first. For the insurance expense, they're telling us that there is an unadjusted balance there of 7,200. And they're telling me that for the prepaid insurance, right, there is an unadjusted balance of 300. Now that's what's sitting there. They tell me at what, March 31st, year five, and they tell me that's unadjusted. In other words, that was what was sitting in the count at the beginning of the year when they went ahead and not at the beginning of the year, but when that old policy expired, okay, they put this 7,200. What they did is they debited insurance expense for 7,200. And the prepaid insurance only had 300. So this is a company, and you'll run into maybe small companies like this that say, okay, we paid the insurance, so put it all in expense. But if the policy has what? Has a 3-year policy, okay, then obviously it hasn't all expired at the immediately upon payment. We have future economic benefit. It really should have gone to prepaid insurance. Okay. So when I look at this, I think to myself, okay, if that's the case, and we're sitting here and at March 1st, because they hadn't made any adjustments, at March 1st, the beginning balances at March 1st were 7,200 in insurance expense and 300 in prepaid insurance. By the time we got to March 1st, that 300 had expired. The 300 would no longer be prepaid because it's expiring at March 1st. And so you have to go ahead and you have to do what? You have to debit the insurance expense for 300 and credit the prepaid. Okay, that's recognizing the fact that at March 1st, when they went ahead, this was the balance, and when they went ahead and paid that new policy, it's because the old one is expiring, so I have to take that insurance expense. Then the next thing to realize here is, well, look, if there was 7,200 sitting in the insurance expense. What they did was they debit insurance expense, credited cash. What they should have done was what? Debited prepaid insurance and credited the cash at the time that they paid that. Not do what they did, debit insurance expense, credit cash. Yeah, credit to cash, of course, but what? Debit prepaid. So now we're getting there, okay? But the question asks what should be at year 5, okay? And that's when we get into the calculation. And Friday, you did a good job here calculating the insurance expense for the month, which was what? $7,200 for 3 years. 3 years times 12 months is 36 months. So you divide that over 36 months, that's 200. That would have been the insurance expense for March 1st when the new policy went into effect to the end of the month of year 5 at March 31st. So we need another what? We need another, sorry guys, I should have credited insurance expense and debited the prepaid, right? Take it out of the expense. Okay. And then go ahead and debit the insurance expense for this 200 and credit the prepaid for the 200 at March 31st. And so when you do that and you do the sort of math on that, okay, the balance is going to be what? The balance is going to be 500, right? Those two cancel each other out. 500 in the insurance expense. And when you do the math on this, you end up with what? 7,000 balance in the prepaid, which was the correct answer. I guess the correct answer was B here. Question. Unfortunately, guys, I can't point to, hey, make a flashcard of this or the key word was that, but it is important that you get good at looking at adjusting entry questions. This is a 10-point area on the exam. So Friday, thank you for asking this question. It's a very good question. Very important area for the exam. The examiners are going to expect you to know how to take a situation where an entity has made an incorrect entry, and as a CPA, this is what CPAs do. And everyone's always, asking me tax questions and so forth, and I'm always like, "Hey, I'm not a tax guy," and they're like, "Well, you're a CPA." I'm like, "Well, show me an error that was made in financial statements, and I'll help you fix it." But I'm not a tax guy. Okay, questions. Okay, good. If there's no question on that, let's go ahead and let's take a look at, and this is the one, I don't see the person that asked this question, so I'm gonna wait. Okay, so let's go ahead and let's take a look at this one. And by the way, I try not to expose names in these questions. And Friday, thank you for, it's nothing to be embarrassed about at all. And I don't have to not show names, but I try not to just in case someone's sensitive there. But if I show someone's name, it's okay. I think we're all working together here towards the same goal. Okay, but let's go ahead and look at this one. And this was multiple choice question 12608. And so I guess I better put that question up. So let me get into my Becker software. And we are looking for multiple choice question. I believe it was 12608. Is that what it was? Yeah. Okay, good. Now, what we're dealing with here is discontinued operations. So what happens? What's behind this? And this has been on the CPA exam for a long time, one of the areas the examiners like to focus on. Okay. And 12608 is the question. And when we're dealing with discontinued operations, here's what happens. FASB looked and they say, okay, you're a company and you have different divisions of your company. Let's say you're GM and you have all these different products and so forth, different car products. You have Hummer, I guess. You have all these different GM cars that are different Cadillac, different divisions. A long time ago, they had a brand called Oldsmobile, okay, under the GM umbrella. And they discontinued that years ago because nobody wants to drive around in an Olds person mobile. Everyone wants to drive around in a car that's going to make them look younger and stuff, right? And so they finally, hey, we better just go ahead and discontinue Oldsmobile. Now, the idea when a company has a large segment and they go ahead and decide to get rid of it, we want to carve that information off from the rest of the company's financial information so that users of the financial statements can see the effect that that particular entity had on operations for the year. The logic being that it's going to go away pretty soon. It's not going to be here anymore. Maybe by next year. Maybe we got rid of it during the year, whatever, but we want to siphon off the effect that that's having, particularly on the calculation of my net income, because it's not going to be affecting net income going forward in the very near future. So, with that as the logic or the objective of what FASB is trying to do here, and I'm not 100% sure if it was FASB that came out with these rules or the Accounting Principles Board, but what the standard setters are trying to do here is they're saying, yeah, you got to take the entire result of the operations of that discontinued segment and show it separately on the income statement. So you'll have what? You'll have your income from continuing operations, in which you're going to have your operating items, right? This is, by the way, F1. Your non-operating items, your taxes indicated on the income statement, and then you have your income from continuing operations, right? And then the discontinued operations show up as its own little section on the income statement, and the entire results of the operation, everything that happened that year, is shown on the income statement in a separate section, and it is shown net of tax. It is shown net of tax. Okay. Those are the rules. And you take any amounts in the year in which they occurred. Okay, because sometimes the question will try to trick you into, well, they're going to sell it. They estimate they'll sell it at a loss next year for a certain amount. You don't take that if it doesn't happen until next year, you don't take it this year, you take it next year. So the rules are what? Separate section on the income statement. Everything that happened that year for that company, everything that happened for that year for that company, right? You show that net of tax and you take the amounts in the period they occur. You don't take anything in advance of it actually occurring because sometimes questions try to trick you into that. Okay. So when we look at this question, they tell us for the 8 months ended August 31st, year five, the carpet division of a flooring company, which is considered a major line of business, had operating losses of 115,000 from operations. On September 1st, year five, the board of directors voted to discontinue the division's operations. On December 31st, year five, the division was sold at a pre-tax loss of 135,000, and the division's operating losses for year five was 240. Now, this is what made this question tricky. Is they gave you that 115 amount for the first 8 months to try to trick you into saying, well, okay, I shouldn't take amounts that happened before the decision. I should only take amounts that happen after. No. Everything that happened to that division that year needs to be reported in the discontinued operations section. Again, remembering the objective of what the accounting standard setters are having us do here. They want us to show the entire results of the operation of that thing that's going away so that investors and creditors, users of the financial statements can look at that a little differently and say, okay, that's going away. And we show that information net of tax. I look, they tell me the tax rate is 30%. I'm good to go to be able to answer this question. So I take a look and I take that 135,000. And when I do these questions, guys, I write numbers down that as I realize that I need the number to answer that question, I write it down. So I don't have to, okay, I know I have to use that number, but what was it again? I write it down as soon as I know I'm going to use it in the calculation. So the 135,000, which was the loss on the disposal of that segment, the 240, which was the losses for the entire year, whatever it was, year five in here, that 240,000. I add those together. And then the way I like to do the after tax effect is I take one minus the tax rate. Okay, leaves me, once I've backed out the effective taxes of 30%, I'm left with 70%. I did the multiplication there and I get 262,500, which was the correct answer here. Question. Now that I just said to you, that's a good flashcard. Okay, that you can flashcard, right? Discontinued operation section. What are the elements? Loss from operation, any impairment loss, which this question didn't contemplate, but if it did give me an impairment loss, I'd include that. And what? And the disposal gain or loss. Okay, LID, lid. You can even make a mnemonic out of that. Those amounts are taken what? The loss, the entire loss from operation for the entire year, impairment gain or loss, disposal gain or loss, those amounts are taken when? In the period in which they occur, net of tax. That's a good flashcard. And that makes these type of questions, I think you would hope that they give you a bunch of questions like this on the exam. Question. Okay, let's go ahead then if there's nothing on that. And let's take a look at the next question. And this question, I crossed out the person's name, but we're looking and it's asking about a task-based simulation. And they say explain in detail question 3 and 6 of this task-based simulation. And then there's this more generic, what is the difference between the percentage of completion method and the completed contract method, which is most used in real life? So let's take that more generic question. Oops, sorry. I did end up showing the person's name. I didn't want to, but that's okay. Okay, so let's go ahead and let's take a look at this second question first. Okay, and s- let's answer the last question first. FASB would like companies to use the percentage of completion method. Okay, it is the recommended method that FASB would like companies to take. It falls into the notion of recognized revenue over time. And you saw that in chapter two, quite a bit of discussion of revenue recognition. And we say, hey, we recognize revenue over time is one way. And then another way of recognizing revenue is at a point in time. Well, percentage of completion, which by the way, guys, has been around for a long time. I want to say, yeah, the Accounting Principles Board issued a standard for construction contract accounting way back when. So that one's been around for a long, long time. And so even though percentage of completion has been around for a long time versus completed contract, it now falls under the relatively new under accounting standards codification section. I believe it is 602, but don't quote me on that. You don't have to know the numbers of the standards. But now, under that standard, they have placed something that's been around a long time under this notion of recognizing revenue over time, percentage of completion, or point in time completed contract. Now, the major difference between the two is that under the percentage of completion, we recognize profit on this contract as we go along. As we're going along, we'll recognize the profit on this contract. Under the completed contract method, we do not take any profit until the contract is 100% complete. So, big difference there in that we're going to take the profits as we go along, recognizing it as a over time revenue recognition model versus at a point in time, which is the completed contract. FASB would prefer because it's more representative of how we're building this building, say floor by floor, and earning this profit as we go along. It's more representative. It provides a better matching for us. But the rule of conservatism says, hey, look, if you don't have a good method for estimating the percent that you're done, then go ahead and use completed contracts. So we are going to put accuracy first, right? We want to try to be more accurate in how we portray it. And if we don't really know that we're going to have a profit on this contract, or we have no real good means of estimating our progress on this contract, then FASB says, or whoever, I guess the Accounting Research Board said, hey, just wait to recognize any profit until the contract is done. Okay, so that's the difference between, those are the major differences between the two. Similarity between the two, okay, is we take losses immediately. As soon as you recognize that a contract has a loss, I don't care if you're using percentage of completion or completed contract method, you take that loss entirely in the period that you discover that I have the loss. And under percentage of completion, that would mean that if you had had any previous profits that you had recognized previously, you would have to back those out by increasing the loss by any profits that you had taken in previous years on this. Okay. Now, in this question, okay, they were focusing on the balance sheet for this particular scenario. Most questions that you will get in contract accounting, percentage of completion, completed contract, focus more on the income statement. It is rare that you'll get a balance sheet focused question. I think what Becker was probably doing with this question is in case you got a long task-based simulation dealing with con construction contract accounting. We have you ready for that rigors that we're making you go through this. but it also gives a nice review of key points that you will almost definitely see in multiple choice questions. And if you look at the way this task-based simulation was put together, the way when I show it to you, you can see that most of the questions are all about the income statement, but they did throw in a couple of balance sheet oriented questions, which is what the student was asking for question number 3 and 6 in this task-based simulation. Now, what I'm going to give you here is just a very, very simple example of the accounts that were contemplated in questions 3 and 6, and then we'll look at the actual question, which has an additional wrinkle to it. But let's just use a very simple example here, okay? Let's say you're a company, you're a construction company, and you're working on constructing this building, whatever it is, okay? And let's say that you spend $1.2 million cash, okay, on the construction. So what happens? You would debit construction in progress for what you spent, the 1.2 million. Construction in progress is a balance sheet account. It's like an inventory account, right? We're building this building, we're spending money on it. It's like the building is your inventory. So you would debit the asset account. It's a current asset, construction in progress, 1.2 million. Credit cash as you spend that money, obviously 1.2 million. Now what happens? We need some money, so we bill the client. When you bill the client, just like in any other billing situation, you would debit accounts receivable, but you credit this, and it's like a liability. It's current liability, progressive billings, $1 million. Okay. So when you look at this, okay, we have a current asset up there of construction in progress. I know accounts receivable and cash are also current assets, but just focusing on the two that I've sort of drawn the arrows together on. Construction in progress is a current asset of 1.2. Progressive billings is a current liability of 1 million. Which one is more? The construction in progress of 1.2, the current asset is more. So when I report this on my balance sheet, I will net together that current asset and that current liability, and I will report the current asset of 200,000 because the current asset construction in progress is more than the current liability progressive billings. Okay. Now, let's say, and it can happen, I have construction in progress of 1 million. Okay, I paid out cash of 1 million, but I've billed my client for more than what I've spent at that point in time. And it could work that way too. Okay, so what happens? It may often work that way. I know anytime I have any construction done when I'm putting in my backyard or something, I'm paying out some money before the guy ever even gets started. But I don't pay him all the money, by the way. I say, okay, well, we'll do some progressive billings. I'll pay you an amount up front so you can get started, but then as more money comes out, I need to see some progress on this thing, right? Okay. So what happens? You go ahead and you at that point debit the accounts receivable, credit the current liability progressive billings. Accounts receivable is a current asset, cash is a current asset, I know, but now when you compare that current asset construction in progress to the current liability, the liability is more. So on the balance sheet, you'll report a current liability, billings in excess of cash. Okay. Now, this example, just to sort of, help you to understand once the amounts are in those two accounts, how you compare them, and then you report the net. That's the point of that little example. Now, what I'm leaving out is that under the percentage of completion method, you would be doing what? It's not only what you've spent so far that's going into the construction in progress, but also remember you're allowed to recognize some profit as you go along, and that would be added to that construction in progress account. So let's go ahead and let's look at the task-based simulation so we get a little practice with how do you calculate the profit, because even though it's in the context of a task-based simulation in this task-based simulation, um, I could see a multiple choice question, a few of them that are just testing you on do you know how to calculate the profit under the percentage of completion method. So let's go ahead And let's take a look back at the question. If I can find that task-based simulation. And a task-based simulation we were looking at was, I don't know why when I print out information about the task-based simulation, they don't give me the ID for the task-based simulation. So let me just look back at the student's question. 31003, 31003, 31003, 31003 is the mantra. Good. Okay, got it. So notice they give me some information here. Okay. And then they start asking me some questions about the various years. Okay. Now, when we look, um, and they say, question one, calculate the gross profit booked in year one. Okay. So I'm going to go ahead and submit the answer, guys. Okay. So that we can look at it. Okay. And the amount is 300,000, but let's see how they came up with that. You take a look. Okay. And they say, well, the sales price was 2.8. Okay. So you'll take that 2.8. Then the estimated cost, that's the entire estimated cost on the contract was 1.6. So you subtract that 1.6, that means we think we're going to have a profit of 1.2. Okay, so that's step one. Step one is what's going to be the profit on this thing, right? Step two is then, well, how much done are we? Because we're only going to take profit for the amount that we are actually done on this contract. So you go ahead and you say, well, look, if the cost incurred to date are 400,000 and the total estimated cost are 1.6, I'm 25% done. So if you take the 1.2 million times the 25%, that means that you're going to take profit of 300,000 on this contract. Okay. Now, as you come down and you start to look and they start asking us for journal entries here, let's just go ahead and look at the journal entries because I think it's helpful to kind of see how we're going to build up the accounts that are relevant to then the parts of this task-based simulation that was asked about. Okay. So what happens? You go ahead and you would debit your construction in progress, 400,000 credit cash, just like I did in that little example with the 1.2 million and all that. Okay. So you would do that. Okay. So we kind of already understood that little part, right? From the little example that I gave you a minute ago. Okay. Then what? Then we keep going and we have to, note that we have the contract receivable 250,000, the progressive billings 250, right? That's based on what they had billed to date, and that's just like that little example that I gave you. Okay. Okay, so far the example you're showing here, of course, with different numbers is just like I showed you in that easy little example. Okay. As you receive payments on the contract, that's, debit cash, credit contract receivable. That would be a very easy set of points if they asked you that on a task-based simulation on the exam. Okay. Now, for the amount of the profit, remember we said what? There was 300,000 in profit that we calculated following those steps up there. Okay, 300,000. So for that 300,000, and this is different than the little example I gave you, you would go ahead and debit construction in progress for 300,000. You go ahead and you debit construction expense for the 400,000 for the amount that you paid out this year. So you have this weird thing going on where you are recognizing expense for amounts at the same time that you're putting amounts in construction in progress for that 400,000. So you're literally using the same number twice because, and it's okay to do it that way. You're creating this asset, construction in progress, because eventually it's going to be done and you're going to turn that building or whatever it is over to your client. And then any final receivables and whatnot will be settled at that point. But at the same time, since you're taking what? Since you're taking some of the revenue to the income statement for a proper matching of the costs incurred that year, the 400,000 and the revenue or the essentially the thing that's really driving it is the profit that you're getting to take this year. You have to take some expense against that. And so you debit construction expense, you credit construction in progress for 300,000 and you take the revenue for the full 700,000 and that's really a number you plug based on how much you've spent so far and how much revenue profit you recognize. That's the credit to revenue. Now what? Now on the income statement we have what? We have a nice matching there, and then we have the revenue and we have um, the expense. We have a net income now of 300,000, and we'd be able to close that out to our retained earnings so that the balance sheet would be able to balance, of course, by the time we were done with this thing. Now, um, when you now think about the construction in progress account, it has what? It has 400,000, it has 300,000 sitting in there, right? The first 400,000 is 300,000. So now when you look at the question that the student asked about, okay, we have the what? Construction in progress, 700,000, but we have those progressive billings of 250. So now this is back to my little simple example. Since the current asset construction in progress is more than the current liability progressive billings, we would report a current asset of 450,000, which is the answer to that question. Question. Now, um, Kyle Bing, you asked, about the other one, but I don't know. Do I need to cover that other one now that it's the same logic?
No, thank you.
Okay. So flashcards that I think are important here, the real important flashcard are the problem solving steps for the percentage of completion method. Okay. Problem solving steps for percentage of completion method says what? First, figure out the profit, sales price minus estimated cost. And that can change, by the way. Estimated cost can change year to year. And so that profit estimation can change year to year. Okay. Usually the contract price stays the same. But if you notice, the total estimated cost to complete did change year to year, right? Okay. And that can change. But once you figure out the profit, put that number aside. What percent done am I? Okay. The percent done is what? The total cost incurred to date, okay, divided by the total cost of the contract. That's the percent done you are. That's step two. Step uh, three is to do what? Take that percentage and multiply it times whatever your profit calculation was from step one. And then you have the profit that you recognize for that period. The other flashcard would be what? Maybe it's a flashcard, or maybe you just remember now that you will report a current asset or current liability, depending on what, which account has more construction in progress or progressive billings. Depending on which one has more in it, that's the current asset, current liability. Accounts receivable is always a current asset. Cash is obviously a current asset, right? For that particular question. And then the other big rule is the loss rule for both completed contract and percentage of completion. Take the entire loss in the period that's discovered. And if you've taken out some profit from previous periods, you add that to the loss. So let's say in this particular example, after they've taken this 300,000 of estimated profit, and in year, let's say that next year, whatever, they discover, oh, we're going to have a loss of 500,000 on this contract. They would have to take a loss in year two of 800,000 to essentially back out the effect on retained earnings of what? The 300,000 of profit they took from year one, and then catch up the 500,000 loss that they think they're going to have on this in year two. So the loss report on the income statement that year would be 800,000, the amount of profit we took in year one, and now the total loss that we think we're going to have on this contract to bring it up to a net total loss affected retained earnings of, in this example, 500,000. Okay. Okay, good. Let's move forward. So back here. Okay, this is one of these things that you kind of need to start to twist your brain a little bit to think a little bit differently about some things. For some of these CPA exam questions, you end up having to kind of do some brain damage to yourself. I don't know. My mind doesn't think like this. And so for me, I have to sit there and kind of, excuse me, guys, and kind of, I don't know, think in a way that I don't think. Okay. And so this is like not really a flashcard thing as much as it's okay, getting used to that you're going to have to deal with questions that are written like this. Okay. Um, so in here it says that the person was confused because it says the contractor sold evenly throughout the year, but the answer assumes that all contracts were sold on July 1st and uses half of the first year's revenues earned. Since selling evenly means some contracts sold late in the year, like December, which is used only 1 month. Why do we assume half a year instead of calculating the based on the different months? And the person almost answered their own question here. Okay, got close to answering their own question that, if some contracts happen, say January 1st, those contracts were outstanding for the entire, and let's just assume a 360-day year in accounting. We don't worry about, 364 and 1/4. 360-day year is what we use. Okay. And sometimes students will go, wait a minute, that can't be right. Well, look, uh, you don't have any problem when you calculate depreciation dividing it by 12 months, which assumes every month is equal. Meanwhile, they're not. So we assume a 360-day year, okay? And some contracts would have been outstanding if they were issued on, agreed upon on January 1st. They were outstanding the entire 360-day year. And some contracts, right, were issued December 31st. They weren't outstanding at all. They had 0 days. So the law of averages works if that's how your contracts are going out, which if they say they were evenly throughout the year, that means that we're really only dealing with what? 180 days, the average amount of time the contracts were outstanding. 360-day year divided by 2 to get the average of a 360-day period, which some could be 360 and some could be 0. The average of that is 180. So if you assume 180-day year, okay, that means what? Only half the year. So now when you look at this contract, okay, and I think that was the hard part with this question, is Dunn Company sells equipment service contract over a 2-year period. Let me go to the question. I'll go to the question because it got cut off when I tried to scan that. So let me put in the question. Now, I forgot the question number. 577, 577, 577. Oh, multiple choice question. There we go. Okay. So they sell equipment service contracts over a 2-year period. The sales price of each contract is $600. Dunn's past experience is that the total dollars spent for repairs, service contracts, 40% is incurred evenly during the first contract and 60% evenly during the second contract. Now, those two numbers are important because now they're saying, hey, if you're providing that service, right, we're going to recognize service over time on this thing. As you provide the service, you're going to do 40% of that work in the first year, 60% in the second year. Okay, and you sold 1,000 contracts, and you sold them evenly throughout the year. And so, how should you calculate that? And I think we saw the answer was 480. But let's just go ahead and take a look at that. Okay. And the entire calculation here, which is what this part was easy, right? The 600,000. Okay. And then earn in the current year the 40% of the work that was done. But again, since the contracts occurred evenly throughout the year, then some of those contracts, no time has expired. Some of them, all the time, 360 days has expired, right? So that comes out to that 180-day year or half the year. And so you've only earned 120. And so this was asking the deferred, right? So if you've earned revenue, when you get the contract, you sell the contracts, you debit cash, you credit the unearned revenue. And then as you determine you've earned some of that money, you go ahead and you debit the deferred or unearned revenue and credit revenue for 120. And so the deferral would still have a balance of 480. Question. I mean, that's one of those things, guys, that once you see it, now you get it. That if they say the contracts are evenly throughout the year, that means half the year of the revenue you're going to take. Okay. Um, yeah, I don't know why they say contracts is being sold on July 1st. I guess some intelligent person thought that would be a helpful way to illustrate this. I like better 360-day year. You look at the contracts, some, yeah, went the full 360, some have 0 days. If things happen evenly throughout the year, then that means what's the average amount of time that the contracts were outstanding? Well, if the total term could be 360, the average amount of time is what? 360 plus 0 divided by 2 gives you the 180. Okay? Okay, good. That's not something that somebody wakes up in the morning thinking that way. Like I say, you're going to have to be beat up a little bit to get your brain into that mode. I was trying to explain it another way here, but that would have made the situation worse. So I abandoned that approach to showing you. Okay. All right, good. Let's look at this one. If Hunton Inc. sold $100 of inventory for $100 of cash on December 31st, year two, which of the following ratios would decrease? Okay. And the net profit margin. To me, net profit, okay. Um, to me, net profit is net sales minus cost of goods sold is net profit, the way companies report it. And then it's net income that's down there at the bottom. But when I started reading the solutions, they started interchanging net income and net profit, which I didn't like. But I don't think that that was critical to making this not an answerable question. Okay. But the student correctly said, well, wait a minute, look, I would debit cost of goods sold, I would credit inventory. And so would the journal entry be to debit cost of goods sold and credit inventory, which has no direct impact on net sales? And my answer to that would be, yeah, if you ignored the sale. But they tell me that they sold inventory for $100, which cost cash. So the analysis left out the point that there'd also be a debit to cash and a credit to sales that would go with that. And if you have what? If you have sales of 100 and cost of goods sold of 100, your net profit is zero. And if you take net profit of net profit margin, whatever, of zero, and you divide that by 100, that's going to decrease it. The correct answer to this question. Question? Okay. I didn't like this question. I don't mind that the student asked the question. I think it's a little bit mean of a question, but okay. What are you gonna do? We can't. I think if history is teaching us anything, we have learned that we can't make people be nice. Okay, so this is what's happening here in this question, and they just got me. Okay, so they say they have the following beginning and ending balances in their prepaid expense account, accrued liabilities accounts, and accrued liabilities accounts for the year, and they tell us that they debited operating expenses for a total of 100,000, and then they say what did they pay for their operating expenses. Okay, now the starting point of this question, okay, was this 100,000. Okay, in fact, let's look at the question. Um, let's just look at the question first in the software. So this one was, I always forget the number of the question. What's the number of this question? How did I find it? Any thoughts on what the number of this question was? Oh, there it is. 8247. Okay. Okay. And I want to say the answer was what? I think was it 83,000 or 93,000? I forget. Okay, it was 93,000. Okay. That's fine. Okay, so 93,000 was the correct answer, but I just wanted to get to the solution. Okay, and let's just take a look at what they tell us here. They say the starting point of this problem is the 100,000, okay, of debit to operating expense. The increase in accrued liabilities represents operating expenses which have been incurred or used but not paid. To determine the amount of operating expenses which have been paid, the 12,000 increase in accrued liabilities must be subtracted from the 12,000. And that's pretty intuitive, and the student got that, and that makes sense. In that, if you sat here and you had accrued liabilities of 12, that means you didn't, from 8 to 12, that means,
Professor,
yeah,
I can't see the screen. I don't know why.
I can. Can
I
anybody
can,
else not see the stream?
I see it.
I see it as well.
I can see it as well.
Clements, you may want to refresh. Can you refresh your browser?
Um, there's a question asking, do you want to stop entering full screen mode when someone else shares their screen? Should I check yes or no?
Say it again.
Do you want to stop entering full screen mode when someone else shared their screen? So check.
My instinct is to say yes, but does anybody else have any thoughts?
I don't know why this question pop up in my screen.
Well, my instinct is to have you answer it yes, but again, does anyone else have any thoughts? Answer yes, see what happens.
Yes,
Yeah. Can you see it now?
no.
Oh, I think like if you go to all the way to the top, sometimes there's a two tab. One is like meeting, one is like you will see like John's screen. Maybe you need to take, did you see two window on top? It could be happen because it happened to me last time. I thought it's not sharing.
Go to view and see what you see. When you go to the top of Zoom, do you see view up there?
Few options, yes.
Okay. And what are you on?
It's side by side gallery or
Okay.
I have a two tab. One is meeting. Another one is John Lott's screen.
Yeah.
So if you click John Lott's screen and then you will see the screen.
Who's John Lord?
You your screen. Did you see? I'm trying to send
So
it.
under
Did
meeting
you see
info,
it? I sent a screenshot. If you on top, if you yeah,
maybe
just
hang
I
on, I'll
leave
let
and then I
you,
come back.
Gloria, I'm gonna let you share your screen. Hang on a second. I'm gonna stop sharing for a second.
okay, let me
And
see.
I'm gonna go ahead and let participants
Let me see. Wait, how to share screen? I'm not familiar either.
well, no, you hang on a minute. You can't share it yet.
I
Wait a
can.
minute. Um, oh, I see. I have to go down here to do that. Let's see. Host tools, share screen. Okay, go ahead, Gloria. You should be able to show us now.
Okay. Well, 1 second. If did you see my for no.
Yes, I see your screen.
Now you see it mine? Because
Yes.
like I understand. Sorry. Um oh, I'm so many tab. Give me 1 second. Um oops, I don't know where it go. But if you like it's on here or
Well, I
earlier.
don't see how seeing your screen and not mine. So this problem has gone beyond solvable at this point. How could it be that she just doesn't see my screen?
She choose not to see us. You're just kidding. I think because like maybe you try one more time on top. Like if you see my screen here, you will see like two tab on top, and then one is saying like someone's screen, and one is like the chat. Like yeah, does it make sense? It's on top of here. If you like here, my screen and meeting, did you guys see it on top? Like
Okay, I don't know. So I'll record this. Maybe you can watch the recording later, but I don't think we're gonna.
I'm going to leave and then come back to see what happened.
Okay, we'll wait for you.
okay, okay. How to
Why don't we take a break, guys? Let's go ahead and take a quick little 5-minute break. Let Clements work on that,
Okay.
and then we'll come back. Okay? Seems
5
like
minutes. Okay.
the
See you
right thing to
guys.
do.
Yeah,
Okay.
5 minutes.
Okay, guys, I think Clemence's screen is working again now. And we were looking at this question, and we had seen from looking at the solution that if you start with 100,000, oops, wrong camera. 1 second, guys. I don't look good at any angle, but that angle's even worse. Okay, there we go. Okay. Um, that if you start, as you can see here, they tell us the starting point with this question was the 100,000. And then you start to adjust that for the information that they give us on the table. And I agree. The student was saying, yeah, it was pretty obvious that if the accrued liabilities went from 8,000 to 20,000, then there was 12,000 of operating expenses that they incurred the expense. They would have debited expense and credited accrued liability that would have reduced the actual cash that they paid out for their operating expenses. Um, so that's how you would back out that 12,000. And when you do, that gets you to 88,000, right? Okay, now then you start to deal with this prepaid expense. And with the prepaid expense, they're saying, well, look, they paid out um, an extra 5,000 to create an asset prepaid expense. And that would have been like operating expenses to them. And so for that, that means that their cash that they paid was an additional $5,000. And so you would have had to gone ahead and added that 5,000 to the 88,000 to come to 93. Now, when you look at the question, I wrote it over here on the question that the student submitted. Notice there is no choice for 88,000. I mean, the 8,000 to 12, okay, I subtracted 12. I think that's pretty self-evident. It gives me the 88,000. And then you have a choice of either adding that 5,000 or subtracting that 5,000. I don't even know how you would have got to the 117 or the 107. But it to me at this point, it's how do you handle that 5,000? You either subtract it or you add it. Well, look, if the prepaid account went from 5 to 10, then you have to say, well, okay, they paid out another 5,000 that even though it's not an expense yet, it, will eventually be an expense. And if they were actually, doing a cash basis, which by the way, that was what was sort of contemplated here, although the following beginning ending balance and prepaid expense and accrued liability accounts for the year total operating expense debits, which is telling you in effect that they are just paying, showing the amount of cash that they're, I don't know what this question means, what they're talking about. To be honest with you, this question to me is horrid because I don't know what they mean. Debits to operating expenses were 100,000. Meanwhile, operating debits to operating expenses should have at least been um, I don't know what they're talking about. If you debited operating expense, because it makes it look like they actually made this entry of debiting the operating expense and creating the accrued liabilities for 12. So they don't make it clear if they're a cash basis accounting or what. So again, the way I would have tried to answer this question is boil it down to a 50-50. I get the 88,000, I guess. Okay, subtract that 12, that makes it 88,000. And then for the prepaid to go up 5,000, they would have had done what? They would have um um debited um prepaid and credited cash. But why are we adding that to debits for operating expenses for the period? But it would make sense to go ahead and add that 5,000 to come up with the right answer here, which is the 93,000, or you could have subtracted it, which would have made it 83, and you could have got it to a 50-50. I can't explain this question. I have no idea why, what the hell they're talking about here. If the total debits to operating expenses were 100,000, then by logic, that should include the 12,000 increase in accrued liabilities by virtue of the entry that they show me there. So I should have subtracted that, which I did. Okay, that's the 88. I see. Okay. So that's the 88. They debited operating expense. Okay. But then the prepaid, it said, what amount did they pay for operating expenses? Well, the increase in the prepaid isn't an operating expense, it's a prepaid. You see how stupid this question is? So I see why the student submitted this. If the 5,000 goes to prepaid, then it's a prepaid, it's not an operating expense. So I don't know. The way they set this question up was really kind of weird. Sorry, guys. I don't have answers to everything that somebody's come up with in life, but I would have never put a question like this on an exam. But when the moral, what I can coach you on here is that if you run into a problem and it's got some ambiguity in it and so forth, like this one does, you can narrow it down to a 50-50. There's no 88. So I know I got to do something with this $5,000 difference. My choice is to subtract it or add it. And since the journal entry to increase the prepaid from 5 to 10 would have been a debit to prepaid and a credit to cash, and then I'm going to somehow say that that prepaid was debited was somehow an operating thing as an operate seen as an operating expense, then yeah, then that would make 93,000 the right answer. That leap, that last part of the leap that's a pretty far leap. AIC and PA authored and probably thrown off the exam for being a stupid question, because once they release a question, that means it won't be on the exam anymore. That means that they themselves probably saw the stupidity of this question and threw it off the exam. Question. Okay, guys, that'll do it. I'm not going to answer that first question because I'm going to be sending an email to the person that sent it in asking them what happened. Okay. Question? Going once, going twice. All right, guys, have a good evening. I will see you in a couple weeks. Okay, make sure, let's go ahead and let's look at the syllabus. Let's do that. So our next meeting will be the 21st. Okay, and you can see the names of folks, okay? And of course, you are not limited to submitting questions by your group affiliation. Anyone can submit a question. And it can be from any of the chapters, 1, 2, or 3. Please don't submit questions for the other chapters since we haven't gotten to them yet. Okay, guys, have a good rest of the evening.
Bye.
Bye-bye.
Thank you.
Bye.
Thank you.